Chapter 1, An Introduction to Managerial Accounting. Learning Objectives. 1. Understand the basics of managerial accounting. 2. Understand the role of globalization and the lean business model in influencing managerial accounting. 3. Understand the importance of professional responsibility. The management cycle. Management analysis and information, planning, implementation, and outcomes. Transactional data transformed using appropriate accounting policies, concepts, and techniques. Managerial accounting reports for internal use by managers. Financial accounting reports for use by external stakeholders such as shareholders, analysts, and creditors. Planning, plans, budgets, control, cost and profitability reports, variance analysis reports, balance scorecard, financial reports, balance sheet, income statement, statement of cash flows. These are the vision, mission, objectives, and strategies. Strategy. The general direction in which an organization plans to move to achieve its goals and objectives. Planning. Selecting a course of action and specifying how the action will be implemented to achieve goals and objectives. Examples of managerial accounting and planning: budgeting, forecasting, performing what-if analysis. Implementation. Carrying out day-to-day activities, making short-term and long-term decisions, allocating resources, directing and motivating people to execute the plan. Examples of managerial accounting and implementation: performing relevant cost analysis, cost volume profit analysis. Control. Obtaining feedback to ensure that the organization is moving towards the goals and objectives. Examples of managerial accounting and control: preparing recurring and ad hoc accounting and performance reports. Managerial and financial accounting. Managerial. Accounting provides information for managers of an organization who direct and control its operations. Financial accounting provides information to shareholders, creditors, and others who are outside the organization. Differences between financial and managerial accounting. Financial accounting users: primarily external to the organization, investors, creditors, regulatory bodies. Managerial accounting: primarily internal to the organization, managers, and other decision makers. Time horizon: financial accounting, historical perspective. Managerial accounting: historical and future perspective. Verifiability versus relevance. Financial accounting: emphasis on verifiability. Managerial accounting: emphasis on relevance. Precision versus timeliness. Financial accounting: emphasis on precision. Managerial accounting: emphasis on timeliness. Unit of analysis. Financial accounting: entire organization. Managerial accounting: individual organizational units or the entire organization is necessary. Regulation. Financial accounting: must follow prescribed accounting standards like International Financial Reporting Standards. Managerial accounting: no prescribed standards or prescribed format, extent of detail decided by management. Requirement. Financial accounting: mandatory. Managerial accounting: not mandatory. For the manager: emphasis on the future. Relevance of data. Planning is a critical part of managing data that is appropriate for the decision at hand. Emphasis on timeliness. When information is required, a reasonable estimate is better than missing an opportunity waiting for more accurate information. Focus on segments. Planning and decision-making often occur throughout an organization. Regulation. Internal reporting guided primarily by benefits from using the info outweighing the costs to obtain it. Not mandatory. The simple question becomes, is having the information useful? Reasons for increased relevance and importance of managerial accounting. 1. Expanded competitive boundaries, globalization. 2. Higher expectations of businesses to be ethically, environmentally, and socially responsible. The lean business model. The main idea underlining this model is to eliminate waste. Companies incorporate practices with this goal in mind. Consumers and customers no longer accept that the costs of waste are passed on to them in the prices they pay, or in the time they wait for products and services to be delivered. These practices include just-in-time, total quality management, process reengineering. Theory of constraints. Just-in-time. Receive customer orders, schedule production. Receive materials just in time for production. Complete parts just in time for assembly into products. Complete products just in time to ship to customers. Benefits of a just-in-time system. Reduced inventory costs, less warehouse space needed, higher quality products, more rapid response to customer orders, greater customer satisfaction. Total quality management. Plan. Study the current process, collect data, analyze the data to identify possible causes, develop a plan for improvement, decide how to measure improvement. Do. Implement the plan on a small scale if possible. Collect data. Check. Evaluate the data collected during the do phase. Did the expected improvement occur? Act. If the results are successful, make the change permanent. If the results are not successful, try again. Process Reengineering Part 1. 1. A business process is diagrammed in detail. 2. Every step in the business process must be justified. 3. The process is redesigned to include only those steps that make our product more valuable. Process Reengineering Part 2. 3. The process is redesigned to include only those steps that make our product more valuable. Anticipated results. Process is simplified. Process is completed in less time. Costs are reduced. Opportunities for errors are reduced. Theory of constraints. Constraint. Restrictions or barriers that impede progress toward an objective. Theory of constraints. A sequential process of identifying and removing constraints in a system. Theory of constraints. Identify the constraint, weakest link. Limit the strain on the process, system, to the capacity of the constraint. Focus on strengthening the weakest link. TOC focuses improvement efforts on objective achievement barriers. Importance of ethical responsibility and corporate governance. Ethical practices build trust and promote productive relationships. Unethical behavior is often the result of managers focusing on short-term results at any cost. To prevent unethical behavior, companies and professional organizations have written codes of conduct which serve as guidelines for members of their profession. Corporate governance enhances stakeholders' confidence that an organization is being managed in their best interest, not only in the interest of top management. Implications of changing business environment on managerial accounting. Systems designed in the early 1900s no longer line up and support organizations' planning, implementation, and control activities in the ever-changing business environment. Managers must question the usefulness of their existing managerial accounting practices and replace obsolete tools and techniques with more relevant ones. Chapter Summary. Managerial accounting provides information to managers to make better informed decisions to help the company fulfill its mission and achieve its objectives. Businesses have incorporated lean business practices to respond to the increased competition due to globalization. Organizations have implemented formal ethical codes of conduct to promote all employees to behave in an ethical manner.